Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today Mena and I would like to talk about employee share ownership schemes. So this is just a fancy word for situations where businesses can start sharing equity with key people in their team, or potentially the whole team if that's what they really would like to do. And our observation is that a lot of small businesses don't entertain these sorts of arrangements. And look, on the face of it, they might seem complex, and they certainly do have some element of complexity to it. But we believe that in the right environment, in the right business, with the right team members, it can be a really valuable process for harnessing and retaining value in your business. So that's what we wanted to talk about today.
So I'll talk about the first sort of advantage of employee share schemes. And again, this is more so targeted at the sort of small to medium businesses rather than, larger listed entities. But what it allows you to do, or one of the pros about ESSs, is that it allows you to attract and retain talent. So it allows you to incentivize employees to join your business. So say, for example, you're a startup and, you don't have the flexibility to pay the same salaries as, some of the larger businesses out there. Providing employee shares from the onset can make the remuneration structure of that for that employee a lot more competitive and a lot more appealing for them to join your business. Conversely, if you've already got employees within your business, it allows you to retain them. Offering shares within your business as part of a remuneration package encourages them to stay longer because they've got an equity stake. They want to see the business thrive and grow in value so that their equity position also grows.
Another advantage is it aligns sort of the business's goals with the employee's goals. And if they're going to help build your business, well, then, I guess it's fair that they're remunerated based on that. And as the saying goes, no one checks the oil in a hire car or rental car. And the idea is that, you don't have a vested interest in it, so why would you check that it's okay? But what you want is people, particularly the key people in your business, to treat it like their own. And if they're going to treat it like their own, they need to have ownership and be rewarded like it's their own. And so if they make a decision today that's really in the long-term best interest of your business, but might have some negative short-term consequences, you want them to make that right decision. And by them having ownership in the business aligns, both parties' goals, your goals as the owner of the business and their goals as someone that's working in the business as well.
And then it's rather cost effective because you're actually not giving out any cash. You're giving them equity within the business. There's no upfront capital required. So, again, I'll use the example of a startup or a business that's in its growth phase. Cash flow might be limited. So by providing employee shares, it shows the employees that they're valued, but they're in there for the ride, So it allows the business to conserve capital. It allows it to reinvest its capital. And there's certain tax advantages with ESSs in that there's no immediate tax burden for employees when their shares are granted. It's more so when they vest. So basically you can grant an employee some shares or the option to some shares that they'll vest in 2 years, 4 years, and then the employee is generally taxed at that vesting point. So you have that employee guaranteed for at least 2 to 4 years before you actually have to give up any equity.
In addition to promoting the right behaviours, having an employee share scheme is better than a profit share arrangement. Profit shares arrangements tend to be or can be very sort of short-term focused and might encourage wrong behaviours, whereas an employee share ownership scheme is all about the long term because it's not only about, what dividends might fall off or be paid in relation to their own ownership share. It's also about the actual value of those shares, and they're the two components of return that an employee is going to enjoy. And if it's a great business, highly profitable, or a growth business, most of the returns probably going to come in the value appreciation part of the share. And so what it does is it really does promote making good long-term decisions. There's that saying that short-term profit doesn't generate long-term value, and it's so true. And quite often in business, we're sort of sowing the seeds to be able to harvest the benefits over the next 2 to 5 years. It's quite rare in business that you can do something today and it will have an automatic increase or uplift to profitability in subsequent months. It's often you've got to sort of sow those seeds to build the business, and having ownership again rewards people from taking that long-term perspective.
And then finally, it provides you with flexibility in terms of the remuneration or the scheme. So there's various types of schemes in terms of whether it's options or restricted shares or performance shares. And what that means is you can tailor the share release or the granting of shares to certain targets. For example, if an employee has performed quite well and you want to give them a bonus, instead of giving a cash bonus, it can be in a form of shares. If you want to retain the employee for a certain period of time to, they're working on a project-based job that you will only see the benefits from in a few years' time, then you can restrict their shares that they don't vest in a couple of years and so forth. So they're quite flexible in their arrangements.
So there's some of the benefits, Mena. Let's talk about some of the cons associated with having these sorts of schemes. And I think the first one is really cost and complexity. So, there's obviously some cost associated with establishing these sorts of arrangements, particularly around legal and accounting fees. So you're going to need a lawyer to sort of draft up agreements and documentation with respect to, how this scheme will operate. And then, of course, one of the key components is, having the business valued, so striking a value or value per share. And of course, your accountant, a holistic advisor can help you do that. And then also you've got to decide what sort of reporting transparency will shareholders also receive. And, you need to sort of think about that. So not only is there some upfront cost to establish, but, on an ongoing basis, you might have to do annual or biannual valuations of the business, some reporting to shareholders, and then dealing with shareholders that join the business and exit the business as well. So that gives rise to additional cost as well.
Another con is that you obviously dilute your ownership. The more equity you give out, that means the less equity there is for you as the owner of a business. So there's a risk of over diluting and a risk of, impacting your control over the business. So, it's something that you need to plan carefully when you're granting these shares, that you still maintain control, and you can always, with good planning, raise more capital or issue more shares to limit this risk.
And if you're using shares as a means of rewarding behaviours in terms of the value that's derived or delivered by key team members, you as the owner can also then enjoy the sort of same benefits. So if you've got a whole bunch of KPIs and you're going to issue 0.5% value to, your key people, well, as an owner, maybe you should be also getting 0.5% as well to reward your effort as well. So that'll help sort of to some degree the dilution aspect. And then also, you don't want a situation where it makes the business really difficult to run. So you still want some key decision makers, and so you might not make those shares that you issue to be voting shares. They could be non-voting shares to, again, allow you to retain control. Another concern that sometimes people will have, and it can work in both ways, is the uncertainty around business valuation. Of course, if your business is relatively new and you're issuing share capital to attract good talent into your business and you're hopeful of, a good growth trajectory, that might be all well and good, but if the business isn't valued very much today, you've got to then give away sort of almost too much equity to, attract those great people. So you want the business obviously to have some value, I think, initially, and the more value that has, well, arguably the more value there is, or greater attraction there is for team members to participate in these sorts of arrangements. Of course, it's a mechanism to reward great behaviours and great output. But if the business value doesn't move in the right direction, which could be for reasons outside of your control, so multiples might change in a business industry, or industries can change that has an impact on business value. Not so much you can do about that other than consider it, and then also educate your team members around these things can occur. Again, if everyone's on the same page in terms of taking a long-term view, you might say, look, there could be some volatility around value, but in the long-term trend should be positive. You don't want the business to be too expensive, of course, because if you overprice it, you are actually removing potential upside that's going to attract team members. But by the same token, you don't want to undersell yourself either and give your business away for free. And so striking a right balance there, I think, is really important to make sure that an arrangement like this is going to do its job, which is really attract and retain and reward great talent, and making sure that it's going to be as effective as possible to do that.
And then there's certain tax implications for the employees themselves when they receive the shares. Obviously, there's going to be a tax burden for the shares that are vested or the shares that are granted to the employees. And they might not necessarily have the cash associated to pay for those shares, because when the shares are granted, they're assessed at the price that they're granted at and at the quantity that they're granted at. And if they don't have the cash, then they're forced to actually sell the shares to meet the tax liabilities. Now, obviously, if there's a period of downturn in the business and that valuation goes less than what the shares were granted at, then there's a shortfall of tax to be paid and they don't necessarily have the cash for. So it's really important to plan around the valuation, as Stuart mentioned. Make sure you go under. There's a lot of disruptors to certain industries that may affect the valuations and multiples and so forth. So it's crucial to keep on top of these. And then there's also considerations around employee expectations. Now, when there's employee shares, especially in startups, and we see this a lot in, for example, IT startups, where the employees, when they're being onboarded, they're promised the world in terms of what the company's going to be, whether it be the next Google, Microsoft, or the likes. So there's a lot of emphasis placed on what these shares could actually eventuate to, or the value that they can eventuate to. So there could be, as a result of these unrealistic expectations, as the employees begin working, there might be motivation problems because they can see that the business isn't progressing the way that it was intended to, or it derails the business in its entirety, really. So it's really important to set clear employee expectations from the start, and in terms of business directions and values, so you don't end up with short-term problems.
Okay, so what are some of the things that you might want to consider to decide whether an employee share ownership scheme will be something that's going to work with your business? Well, I think the first thing we need to think about is business structure. You want to have a unitized business structure that is going to accommodate, the issuing of a specific sort of ownership percentage or specific entitlement to your business. So we're talking probably about a company or unit trust structure in that situation. And you want to then think about, the existing sort of capital structure of those entities. So whether it's a company and how many shares are on issue, and whether you're going to transfer shares or issue new shares to sort of fund the employee share ownership scheme. Both have their pros and cons, particularly around, the potential dilution and those sorts of things. So that's really a conversation with your, holistic advisor around these sorts of things. The next consideration is you want to think about, why would you want to implement something like this? So is it about attracting new talent? Is it about rewarding the behaviors that, a salary doesn't otherwise reward? Because I like to think about these things like, if you've got an employee and you're paying them a salary to do certain tasks, is that the role of an employee, or are they doing things that a business owner would do and would then therefore get expected to be rewarded for that? So, that could be sort of business development sort of stuff. It could be internal training and mentoring of staff and those sorts of things that kind of a little bit outside of their, I guess, core job role, if you like, and that's what you're looking to do. Or it could be just a retention play. You've got some really key people in your business. Your business might not be experiencing huge growth, so it's not about attracting new talent and better talent, but it's really about holding on to the talent that you've got. But I think it's really important to work out what's the key aim here in terms of what you hope the employee share scheme will deliver.
Definitely. And I think it's really important to also communicate with your employees the risks and benefits and the structure of the ESSs, because if these aren't clearly communicated and you've got unrealistic valuations or unrealistic expectations of the business and it's overly sold, then again, like we mentioned before, it affects the motivation levels of your employees. It's very short-sighted in its approach. So it's really important to communicate these clearly with the employees before you implement any such approach. And then obviously Ideally, you would encourage your employees to get their own sort of legal and tax advice around these schemes, just to make sure that they're across it. It's even more so important that you yourself get legal and tax advice from your accountant and solicitor, so that you're across all the relevant regulations. As Stuart mentioned before, that it is a bit complex in their approaches and the regulations required around employee share schemes. So it's really important to minimise the risk for both yourself and your employees.
So there you go. There's a little bit of a summary of employee share ownership schemes. The big end of town use them really well. Of course, if you're a listed entity, it's to some degree a lot easier and they've got more scale. But they shouldn't be regarded as just something that the big end of town utilise. That we believe a lot of smaller businesses can also utilise employee share ownership schemes, attract great talent, reward existing talent, and retain key people can be a really valuable thing. And there is a bit of complexity there. There's a bit of cost associated with it. But once it's up and running, and as long as it's communicated in a very realistic and transparent way, and everyone kind of knows the rules and the playing field, we think these things can work really well within small to medium enterprises as well. So, of course, if you think it's going to suit you or your business, it's something that we'd recommend you discuss with your holistic accountant. Until next week, bye for now.